I've been getting a few questions of where's Hive or where's RHT? Have you sold out of Docebo or Dye and Durham? Well, no, I've not sold out of any of these positions, and my TFSA portfolio is a separate portfolio from my other Wealthsimple portfolio, which is a cash portfolio. And just for full transparency, over the past month or so, I've just been super busy with work and haven't been able to get around making as many videos as before. Plus, I'm also trying to fix my sleep schedule, as oftentimes when I'm filming these videos, I stay up till 1 or 2 a.m. editing them, and the next day I have to go to work and I'm pretty darn tired. So for that reason, I've been a little bit slower on videos in March, but hope to get back in the swing of things, maybe doing 2 to 3 videos a week from now on. Now jumping into my main growth stock portfolio on Wealthsimple Trade. You can see here on the right side, it's currently worth $43,221.78 as of today when I'm filming. And all the positions I have, Absolute Software, Acuity Ads, which is a new one. I sell the Bitcoin ETF, I have Converge Technology Solutions, Docebo, DCM, which is a new stock, and I'll be talking about that one a little bit later on and explaining you my bull thesis behind that. Then I have Dye & Durham, CloudMD, MCI One Health Technologies. Subscribe if you want to see a review on that stock, because I will be coming out with content about why I'm bullish on this company for the next 5 years or so. GDMP, GRN, HEO, Hive, Kits, Lightspeed, NewPath, RHT, Shopify, SVI, Waste Connections, and Well Health Technologies. So these are all the positions that I have, and I'll just scroll through once again to show you how much I own of each stock in terms of dollar amounts. The one position that I do want to give a brief on is Lightspeed actually. So I sold off Lightspeed, I think last update, and I sold off all 40 of my shares over the past, I think January and February. And the reason why I sold off Lightspeed is because I saw it was a little bit overvalued and I felt like the market was frothy, and I wanted to just sell it off in case that the market came down. And Lightspeed was slightly bit of a lower conviction play of mine because I already own Shopify and I'm super bullish on it. So for that reason, I ended up selling off Lightspeed. But when the stock dropped to around $80 to $83, I decided to get back in as the market was turning around, and I didn't mind holding a few shares of it, so I decided to start averaging in under the price that I bought it at. I won't be talking too much about Acuity Ads as I'm still building out that position and doing more research, but currently I own about 10 shares and it's worth $152.90. So it's a very small position in this portfolio, but I do have some pretty high hopes for it because it's doing similar things to Trade Desk. And although Trade Desk is a major competitor of theirs, I believe that there's a lot of pie to go around for everyone out there, as this programmatic advertising has been expanding and becoming a larger part of advertising dollars for all companies out there. So stay tuned for my update on Acuity Ads when I release a video on my full due diligence on this company. Now let me jump over to my computer and present my bull thesis as to why I believe DCM is an interesting play that you should consider watching right now. Stick around to the end because I'm going to show you how this stock could potentially be a 15 bagger. I'm going to take you through a couple key points in the 2020 annual report. The first one is to focus on core customers. During 2020, their total revenue with their top 100 customers grew by 3% versus 2019. So it seems like despite the whole pandemic and everyone just shutting down, they were still able to grow their top 100 customers by 3%. And honestly, this is pretty impressive to me and kind of adds to the story of how this company could be a turnaround play. They provide services and products to 70 of the largest corporations and government entities in Canada. In seeing that they were able to grow their revenues by 3%, it's clear that they are building deeper relationships with these organizations and providing more value to them, such that these customers are willing to do more business in the middle of a pandemic. The next initiative here is to improve gross margins, and they already increased it by 3 full percentage points in 2020 during the pandemic versus 2019. And one thing I want to highlight here is they want to tackle more growth in resale products and cannabis-related products and services. So this cannabis-related products and services is actually an interesting thing and a pretty big growth driver for DCM. Cannabis product sales already accounted for 5% of total revenue in 2020. And if we scroll down here to look at the revenues in 2020, they earned $259 million of revenue, and 5% of that, if we just do the math here, That's about $12.95 million of revenue from cannabis products. And no, this is not them selling cannabis, but it's actually selling labeling to cannabis companies. Here in the 2019 annual report, we can see new sales from customers in the cannabis sector equaled $2.5 million. That's about a 5x increase in revenue from the cannabis sector in 2020. So I believe we're going to see a lot more revenue growth in 2020 or 2021 from the cannabis sector here. It only equals to about 5%, and potentially they could grow that to 10%. Seeing as they 5x last year to this year I think they could probably at least 2x as a conservative estimate. Their next initiative is to lower the SG&A, or sales, general, and administrative costs. And the CEO right off the bat was very transparent, saying that this was a disappointment in 2020. We failed to deliver on our internal objectives of lowering our SG&A to less than 20% of our revenue. A great part of the issue was our lower year-over-year revenue, a result of reduced performance from our retail and not-for-profit vertical markets and lower levels of transactional client work. But that's an excuse. Despite reducing our SG&A by over $8 million in 2020, we still didn't tackle our organizational structure and only started to reap the savings benefits from our ERP implementation in mid-2019. Now, have you know they've already tackled a bit of the organizational structure by actually laying off 3 executives, and this should severely lower their costs going forward in the future. They declared an $8.5 million savings target this year. Focus on achieving this metric. Down here on the income statement, we can see that they reduced their SG&A from $67 million to $58.8 million. And if they're going to reduce it by another $8.5 million, that's going to bring it down to $50 million. And if we do some calculations here, assuming that they also have some restructuring costs, maybe another $5 million because they do have to lay people off, that's going to put these expenses in this category to about $55 million. And if we're to take that away from 72, assuming that they have the same gross profits in 2021, they're looking at about $17 million of income before finance and other income and income taxes. Let's assume that they have no other income, but they do have some finance costs. Their interest expense should go down because they're paying off debt. Maybe the interest expense is maybe around $3 to $4 million. So that's about $13 million of income before taxes, assuming that they have no government grants, which would basically match what they had in 2020 of about $14.6 million. Basically, we can assume they have roughly around the same amount of income taxes. So the net income roughly for 2021, I'm predicting, is going to be around $10 million. So that would give us an EPS of just under 27 cents per share, probably looking somewhere around 23 to 24 cents per share. Now looking at DCM stock today, we can see the price of the stock is 65 cents. And if we're to do the math on that, 65 cents divided by EPS of 23, that's a P ratio of 2.82. And already the company has a P ratio of, this is wrong actually, 0.65 divided by 0.27. Their P ratio is 2.4 according to the trailing 12-month revenues. So by doing that math right off the bat, this company still seems very dirt cheap. But we have to dig a little bit further into their financial statements and look at their balance sheet. So I'm going to pull that up right now. Okay, so we're here on their balance sheet, and currently they have about $75.9 million of current assets, and they have $60.9 million of current liabilities. So they have enough current assets to cover their current liabilities. On top of that, if we look at their total assets, about $163.9 million versus their total liabilities of $153.9 million. So they have more assets than liabilities, which is great. But when we look at this, we can't really take this at face value because intangible assets are really nothing. Goodwill also equals out to nothing. Right of use assets are pretty much a wash. These are basically the facilities that they have the right of use to use over the next 5 to 10 years. And likewise for the non-current liabilities, their lease liabilities, if they cancel their lease, they don't have this liability. Credit facilities though, this is debt that they need to pay down in the long term. But you can see from 2019's numbers, they were at $74.7 million of credit facilities, and they paid off pretty much half of that, down to about $39.5 million. So DCM really did a crazy year in 2020 and paid down a lot of debt. So based on this, I really like the way that management is handling the debt so far. And they paid off half of that in 2020. And I expect them to pay this down to maybe about 20 or even $15 million. Because this business, if we look at the cash flow just a little bit further down, they're cash flowing quite a bit from their operations. So from their operations here, we can see they're cash flowing about $47.6 million. That's more than the current market cap of $30 million. They do have some financing costs because they repaid their credit facility. So they're probably going to use a lot of the cash flow from their operating activities in 2021 to also repay their credit facility. One last thing that I want to highlight here is their operating margin. So we can see here in 2019, their operating margin, if you do the math here, which is gross profits divided by the revenues, is around 24.4%. And if we look at 2020, we can see that the gross profits of $72.9 million divided by their revenues of $259.3 million, that's a gross margin of around 28%. So they increased their gross margin by 3% in a year where the world was shut down and the pandemic happened, and likely businesses incurred a lot more costs because they had to buy things like face masks and gloves for their employees. So it seems that the company is finding ways to cut costs on every dollar earned. And this is a great sign from management and just kind of shows to the expertise that they have right now, especially with a change in management that's been happening. Now, looking at the outlook for 2021, they recently won several contract renewals from their largest clients. Their retail and not-for-profit clients are also starting to show signs of growth for the balance of the year. And these were the guys that really hurt the revenue numbers, which is why we saw a decline in revenue from 2019 to 2020, because retail was shut down and not-for-profits were basically not really operating. Then they also have a change in CEO, which this new guy, Richard Kellum, has joined them effective March 8th, 2021. Richard has an extensive international career with major packaged goods businesses in numerous senior leadership and operating roles. Richard has a deep understanding of digital transformations, and they have started what is required for them to meet the needs of their client base over the next period of DCM's evolution. So I think his network is basically what his worth is to the company and just his experience in the international scene. And if we look over in study.com, we can see that Richard's also aligned along with all the directors and senior management. So if I scroll down here, this actually shows us that Richard purchased 500,000 shares at 60 cents per share on March 18th. And on top of that, he has about 2.5 million options to incentivize him to continue to build the company. But if we scroll through this list of directors as well as 10% owners and senior officers of the company, we can see that they've all been buying shares in the past year. So that's pretty much my bullish thesis on DCM, but you also have to take into account the risks. So going back to their annual report, again, their debt levels can be worrisome to some investors because their debt levels are currently higher than their actual market cap, 39.5 versus $30 million. So that's one risk that you have to take into account, and potentially they may not have the same performance in 2021. And if they end up having negative cash flow, they might have to withdraw more from the credit facility, putting them into more debt. So this is one big thing that you should take into account if you're looking to invest in DCM, and just calculate the risk that you see from that. Another risk that I can see here is the fact that the revenues did decline. I mean, we won't really know what happens until the whole economy opens up again. We don't know if they are able to have some sort of recovery. First off, because a lot of the revenue still comes from their printing business. So this company originally was a paper printing business. So they're transitioning from that business to more of a digital advertising business that helps service their clients. So if their printing business takes a huge hit in 2021 and they don't scale the digital marketing business as quickly, then we could see their revenues continue to decline. Another risk and big unknown is restructuring expenses. We can see in 2019, they had about $7.5 million of restructuring expenses. In 2020, they had about $2.8 million of restructuring expenses. And with the recent layoffs of 3 executives, we can expect to see restructuring expenses to be pretty high in 2021. And hopefully that will give them the cost savings they're looking for, but there's no guarantee about that. And the last thing that I want to point out is the share price has actually been quite volatile over the past 5 years. It's been trading anywhere from about $5 per share or close to $5 down to lows of around 11 cents per share. And it kind of just shows investors have been selling off the stock and they don't believe this business is worth anything, is probably out the door. However, recently there's been a bit of a spike in the stock over the past year, as we saw management has been executing on their plan and they've been improving the margins, and they actually eked out a profitable year. So this actually is a turnaround play, and for that reason, that's why I'm buying in. But again, the turnaround story is not yet over. And if you zoom out to the larger picture, this company once was a beast, or according to their share price, it was a beast, and now it looks like they're essentially nothing. They could be squashed by competitors. Here we can see the trailing PE ratio of DCM is 2.43. They don't have a forward PE, but I did put a forward PE of around 2.4 as well, based on earnings of around 23 cents per share. Now, if we look at the price to earnings ratio by sector in the US, DCM is under the business and consumer services. And currently the PE ratio for these companies, all 169 on average, is 38.25. So if we were to bring DCM's P ratio up to 38.25. Let's just quickly do that right here. That would represent a 15.7x in the stock price today. And if we were to cut that in half, that would end up being a 7.8x in our investment in DCM today. Again, there are caveats to all this because DCM still has a large majority of their revenue coming from print. So if they're not able to transition that over to the digital, then this business could be as good as dead. And if we were to be even more conservative, I could probably see at least a 2 to 3x in this business, assuming that they execute according to their plan. One last thing before we end this video, I just want to show you the performance over the past couple months. Over the past month, you can see my portfolio has been relatively flat. It's up about 0.68%. Over the past 3 months, I'm up 7%. However, there's quite a big dip in February. And the only reason the account recovered quite nicely is because I did deposit $3,000. So don't let that fool you when you're looking at my performance. I would say the account is not yet back to its February highs, but it's kind of getting back there as the whole stock market recovers. If we look at the 1-year performance, I'm up around 51.52%. If we look at all-time performance, the portfolio is up around 35.36%, or $11,291. Anyways, that's all I have for you guys in today's video. Let me know your thoughts down below, whether you think DCM is a buy or you're going to be doing more research. Maybe I missed a few things, so I'd really appreciate your thoughts about this company. If you guys want to check out other videos of mine, there's 2 on the screen here. If you're there, I'll see you there. If not, keep up the grind and have a great day.